Welcome to Markets Now. I'm Michelle Rook along with Don Roose, U.S. Commodities on a down day in all but old crop corn futures. And Don, we've had a lot of money flow issues, a risk-off kind of trade here. First the banking situation, then the Fed decision. Now that we've got those things, at least the Fed decision out of the way, can we stabilize these markets?
Well, I think when we look at it, I think we're going into the springtime, and I think the market's taken a lot of risk premium out of the market, well under the insurance rate. So your farmer selling is probably going to be very limited here in the new crop. And old crop, we're seeing China buying underneath the market. That's given us some support. We're still seeing the big drought in Argentina, lost price 700,000 or 700 million bushels of soybeans there. So at some point in time, watch the demand underneath the market. Watch the spreads in the market, and we should find some stability here, Michelle.
And corn, as you say, has found some stability, some of that coming from China corn purchases, but is some of it also tied to the fact we've taken some pressure off of that market because the funds have liquidated most of the long position they had?
Yeah, it's just unusual, Michelle, this time of year to have the funds in 1 month. They did a record reversal in their position. They went from long to now short about 60,000 contracts. So going into the spring, you better not have any weather problems or you'll see some short covering there. And remember, we've got issues in the northern plains. And, you never know what can happen here in the Midwest going forward, Michelle. But that's going to be the watch going forward. And then we have the acres and stocks the end of the month.
Yeah, and we'll see what that holds for the market. Soybeans, let's go over there because funds are still long in that market. They're in the meal market. We've dipped below key moving averages today, including the 200 days. So do the funds keep liquidating here and pressuring the market?
Well, I think it should be. I mean, they're long, so that's always a concern. But if the corn market and the wheat market stabilize, probably what's going to happen is the soybeans do also. Remember, Argentina probably lost about 700 million bushels of soybeans. Brazil probably makes up 1.2 billion of that. But we got close to the gap area in November. Beans 12.69 a quarter from July 25th. That should have been a target to the downside, got very close to it. So should find some stability in this zone, Michelle.
Yeah, and I know Brazil's harvest, obviously we're seeing a little harvest pressure at times as well there, but you've got to feel like this market has kind of dodged a bullet because the South American crop is much smaller than where we started with projections at the beginning of this year.
Oh, definitely. I mean, I would say the soybean crop is probably hard to believe. Maybe even as much as 1 billion bushels less than we thought at the beginning of the year. So, that eventually comes into play, and it means that we're going to have to raise the crop here in the U.S. So you don't want to take too much of the risk premium out, or we have to put it back in very, very fast.
And the wheat market also took a hit. Chicago making new lows for the move once again, and the funds are already short that market. So why are they pressing it so hard?
Well, for every action, there's an overreaction. We had $13 wheat a year ago, and so all that's coming unwound right now. And, the big culprit, the big problem is Russia keeps selling wheat below the world market, even at these levels. So it looks like the funds are willing to hug the Russian sales and wait to see if we can find some stability. We'll watch our weather in the wheat area going forward, Michelle. It's probably a couple, 3 weeks too early, but that'll be on the radar soon.
Yeah, and with that in mind, do you think Kansas City has a pretty good shot at continuing to hold this $8 area for support?
Yeah, I think, with the issues that we have still, we see in Colorado and Kansas, our biggest state, still some issues there. So I think we've taken enough of the risk premium out at the present time. See if we can build it back in again, Michelle.
Cattle market, we've taken a lot out of that market as well here just because of this risk aversion, macroeconomic concerns. Do we keep seeing pressure in that market, do you think?
Well, it looks like we're going to trade the cash cattle market $2 to $3 lower this week, probably a lot lower than the trade thought. But there's a gap on April cattle up around 164.22. That's probably going to be a target. We have our best demand of the year, May, coming up yet in front of us. We just went through our worst demand time frame. So I think the market probably finds some stability here. It's a cyclical bull market. We had some weather premium put in the market, and then we took it out, as we often do. So I think that's partly what's going on there, Michelle.
Okay, so a healthy correction in an otherwise bigger bull market then.
That's the way we look at it, and the hogs have to get off the mat after the big pressure they've had.
All right, let's talk about that because we've lost like $13 in the June contract in like the last 7 or 8 sessions. So where do we find the low here?
Well, if you look at the hog market, first we had too big a premium put in the market in the futures, hoping that the cash market could find some support. Then we've taken all of that out, and actually we've taken too much premium out of the futures market now. So it's up to the cash, but if cash stabilizes, the futures should also. The higher priced cattle should help the hog market, Michelle.
Okay. Well, they're super oversold, that's for sure. All right. Thanks for joining us, Don Roose, U.S. Commodities. That's Markets Now.